But when I go back and say what lags, well, CPI lags by at least 6 months, wages by 13 months, and shelter by 16 months. If you look at the Trueflation, which is this on-chain inflation metric, they're showing inflation in the US is currently 4.1%. My forward-looking indicators based on all of the work on the business cycle, and it's not really voodoo, it's pretty straightforward, that stuff is showing we get to 2% or even below by the summer. My work suggests we've got a decent chance that inflation goes negative.
Raoul Pal, former Goldman Sachs executive and CEO of Real Vision, recently discussed the potential for a widespread financial crisis in an interview with Anthony Pompliano. Pal highlighted the failures of short sellers and the increasing mainstream acceptance of cryptocurrency, as well as recent events such as the US government's pushback against crypto and the failures of FTX. These events have sparked fears of a banking crisis, leading the Fed to announce its Bank Term Funding Program to provide liquidity through loans. Pal believes that declining trust in banks and the search for alternative systems could lead to explosive growth in the crypto industry, similar to the chart patterns from 2013. As people become aware of the benefits of alternative systems amid crisis, Pal suggests that Bitcoin and the crypto industry may become increasingly popular.
I think people are dead right in the financial markets is eventually we get rid of all of them, the smaller banks, we end up at bigger banks, and eventually they become conduits for the Federal Reserve via central bank digital currencies. The US is going to be last in that equation. The Europeans, they're going to be much sooner. We're already seeing it rolling out in many, many places. And that is a way of kind of this financial weaponry between the state and the people, which is concerning. Now, there's upsides to central bank digital currencies too. I think they do a great job in certain things and terrifying in others. And this battle will mean that the state takes more power than it should do in a way to keep itself relevant. And we're seeing that blurring of autonomy between the Federal Reserve and the Treasury as well. That happened in 2020. So all of this is becoming the financial construct is becoming a political construct as well. And again, this is one of the reasons, and we'll get into crypto, I'm sure, later, why crypto is hugely powerful in positions like this. So many new people have come into the market. They check a chart of 1970, say that's going to repeat. They then make wild claims that monetary policy is inflationary and the cost of goods goes up because of monetary policy. That doesn't seem to be the case. It inflates asset prices. They then look immediately at 2008 and say, see, this is what's going to happen. And they don't do the work on all of this. And the work on all of this is, firstly, there is a clear path that has been in existence for the last 60 years of the lags and leads of economic indicators.
In March 2023, the Federal Reserve is anticipated to raise the Fed funds rate by 25 basis points to 4.75% to 5%, aligning with the previous increase in February. As a result, borrowing costs are expected to hit their highest levels since 2007, potentially putting the economy at risk of a recession. The U.S. regional banks have come under scrutiny following the banking crisis, posing significant challenges for the Fed. The unprecedented rate hikes in the last 12 months have adversely affected the value of long-term securities held by banks, leading to issues during customer withdrawals. This development has impacted the banks significantly. Pal says, I just don't see an outcome to this banking mess without a few more trillion tacked onto the Fed balance sheet over the next 18 months and rates slashed. The yield curve is currently uninverting. Since the SVB collapse and its ripple effects, the Fed has implemented crisis lending programs to prevent further bank panics. Recently, Pal tweeted that, let's see the Preza, but Fed funds at 5% and a possible tightening bias mean weaker banks. And that will bring Yellen in to guarantee deposits, which won't work due to FFs and the yield curve. My guess is the next move from the Fed is an emergency cut if banks move fast.
The Fed kind of knew that the regional banks weren't great. We also know the pension system's a problem. We also know there's a number of things that can be a problem in this system when you've got a globally indebted situation like we've got today. The world has never been this far in debt, and no country in world history has ever been as far in debt as the US is as a percent of GDP. So it's problematic, but that's just a function of the business cycle. So in a normal course of events, banks make business by something called the steep yield curve. So they borrow at, let's say, 2% interest rates, i.e. they pay you 2% on your deposit, and they lend it out into the market at 5%. That's the yield curve. So that's a longer term duration that they take the risk on. The issue is the yield curve got massively negative. In fact, the second most negative yield curve since 1980. So that means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit, but then they invest it in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they're actually getting less money. So they're losing money every day. So what they did is artificially change the yield curve. So they said, well, we're actually going to give you 0.5% interest on your money, and then we can lend it out in the bond market at something different, at a higher rate. So they manufactured a steeper yield curve. The issue is people have the freedom to move their deposits. So they can move their deposits out of this 0.5% world into a 5% world of CDs, Treasury direct money market funds. So people are incentivized to move their deposits because the rate of interest is actually the highest we've seen for a long time. So people are incentivized to do that. That means deposits shrink from the system. As they shrink, you have to unwind the bets that you had at the long end, the longer maturity bets. Now, the problem is those are all underwater because the Fed raised rates so much. So then they've got losses, mark-to-market losses. But to collapse the deposit base, you have to realize those losses. Normally, you can just leave them on your book because mark-to-market accounting, you don't need to worry about it. But in this case, you have to do something about it. Suddenly, poof, they're all got no money. So that's the real issue here. Now, there is a big shit fight going on about what people should do about it, what the government should do about it, what the Federal Reserve should do about it. People say, well, if people are getting scared now because they saw Silicon Valley Bank and Signature Bank go under, well, we should just guarantee deposits in the system. Okay, sounds great. Problem is, it doesn't get rid of the actual issue. The actual issue is the rates are too damn high. So the banks can't make any money. So if they just guaranteed the deposits, people still go to Treasury Direct and get their 4.5% or 5% yields. So it doesn't stop it, slows it down somewhat, but it's still a huge problem.
According to investor Raoul Pal, the current situation involves banks halting loan extensions, which results in a reduction of money supply and growth momentum. This, in turn, causes asset prices to decline, leading to a shift from risk-taking to risk aversion. To address this, Pal suggests that the Federal Reserve needs to increase its balance sheet by printing more money, which would lead to a rise in collateral prices for assets. By doing so, the likelihood of a system-wide debt crisis, as seen in 2008, can be avoided. In his tweet, Raoul Pal said, "The current real-time inflation, verified on-chain, as of today is already well below Fed funds and in my view will hit likely 2% or lower in June and July."
Did the Fed have any business raising rates as much as they did? Or would the economy have slowed down anyway because inflation ate into everybody's pocketbooks, companies started to see slowdown in growth anyway, and the supply chains were starting to ease up, so inflation probably would have unwound significantly. So should the Fed be at the kind of level of rates that they are at, or did they screw that part up? And my view, which is opposite to most people, is I don't think they should ever have raised rates this far. It's stupid. Other people say, well, they shouldn't have kept rates this low. I don't know, because the economy, trend rate of growth in the economy is like 1.5%, 1.75%. Things are really slow. We're straddled with debts. And we've seen every time we raise rates, the economy collapses. And it's not now just a general recession. We expose some big ugly, which is some leverage under the rug.
As the banking crisis continues to play out, doomsday predictions are coming in thick and fast. Pal anticipated that as individuals lose trust in the conventional financial system and explore alternative options, they might become more conscious of the advantages provided by digital assets, particularly during times of economic turmoil.